Good morning. Today is September 8th. This is Brian Dallin with FS Grain, bringing you another market update here today. I'm going to go over two things here. I think sometimes as farmers, we get a little bit of tunnel vision, put our blinders on, and we focus on our crop and how we think it is. So I'm going to kind of take two perspectives on this. The first one is the supply side of things, right? So there's no question that most of the private analysts out there right now are pegging the U.S. corn yield slightly lower than the USDA, somewhere 168 to 172. The USDA was 175 back in August. Now, next week, they will reevaluate U.S. production, and this will be their first stab at it via actual field data and yield checks that they've done. So again, in general, I think the market's expecting the U.S. corn yield average to come down from 175. On the low end could be 168, which if that was the case, we would have a serious predicament in terms of what the usage is left and where our carryout's at. Because really at that point, carryout in theory could be below 1 billion bushels. Which we would need some serious price rationing if that were the case. And then again, there's some that are saying maybe it's only down to 172. Either way, any reduction is going to be somewhat bullish. However, leaving it stable at 175 would be viewed as neutral to possibly bearish. So we'll keep an eye on that for next week's report. The western mountain region, actually, really, if you want to start in the western edge of Iowa on the border with Nebraska, we're in a serious drought out here. Now, again, Nebraska, the Dakotas, parts of western Iowa, Kansas, we have a pretty serious drought going on down there. Now, a lot of that is irrigated ground anyway, but a drought nonetheless. The farther west you go into the Rockies and then on, of course, out into California, we have what I'm reading is the worst drought in 1,200 years. We have scorching temperatures across Idaho and Oregon and California this week. I was watching last night, seeing they're supposed to reach temperatures up to 110 degrees. So unseasonably hot for this time of year, a just serious drought. Places like Lake Mead are in lowest water levels they've had in years. We're seeing areas that are going to have to start rationing water, things like that. So this is a big deal. Again, farther west, more so out of the Corn Belt, but nonetheless a serious issue in the western United States. And then the La Nina pattern. Potentially, there's some weather analysts talking that La Nina could go into what would be its third growing season in South America. Now, the way it kind of pans out, it splits a little bit between either the Brazilian corn growing area or Argentina, but either way, one of them typically is drier than usual. So if this extends even longer, we could be looking at the possibility of some not great weather for their growing season. Again, they're probably a couple weeks away here from getting started planting their first crop. So again, we're going to have to keep an eye on this. All these things are affecting the world supply of grains as South America, and obviously here in the U.S., we provide the majority of that. Couple that into the issue going on in the Black Sea and how much grain is actually getting exported and or getting planted and harvested. They did better, I think, than what we originally anticipated. However, they're certainly not at 100% over there. So world grain stocks appear to be shrinking. And again, this is the supply side of the situation. If we shift over to demand, there's a few things here that I want to make sure we're keeping in mind as we do our marketing going forward. Obviously, China is in another lockdown right now. They are continuing their policy on a zero. What I want to say that any cases require complete lockdown for COVID. That is currently right now. There's about 65 million people in China are in a lockdown situation due to COVID cases on the rise. Now, put that in perspective, that's actually more than double the population of California. So just kind of think about that for a minute. That many people are not working, are locked down in their homes until further notice due to COVID cases. So obviously the Chinese economy is going to be slowing down greatly. And that's one of the big fears going forward here is, one, this affects the supply chain around the world as so many goods come out of China. But two, their economy up until the pandemic had been on the rise, had been really exploding, and this pandemic has just handcuffed them completely, and it continues forward. So, will China continue to be able to buy going forward, or is their economy slowing where they'll start to pump the brakes a little bit on their purchases? Crude oil, we always have to keep an eye on that. Crude is dictates a lot of our ethanol market here in the U.S. So, the crude oil market's really been beat up here the last few days. Kind of the same concept there being that we're out of our peak driving season. This is also if the U.S. is in a recession and we have inflated costs and interest rates on the rise, will this cause people to travel less, save more? And again, so crude oil has really dropped hard. And this kind of hurts ethanol. At $7 corn at $130 a barrel, ethanol is very competitive, making good margins. $7 corn at $80 a barrel, it's really starting to cut into it. So if the crude oil market continues to drop, this will cut into margins on the ethanol market. Europe, just short of a complete disaster right now with their energy crisis. They're with the pipeline being shut off from Russia, possibly on again, off again. It's just a complete disaster trying to manage their energy needs, and they're going into, we're a couple 2 months away from winter here, so that's when they're going to need all the natural gas they can get for heating. You couple that with their high cost of electricity right now. Europe is in a serious economic disaster right now, and again, that's all part of the demand part of the equation here as we look at it. So things to watch going forward here. And then last but certainly not least, the US dollar is just continuing to make new highs here at 110. So every time the dollar rallies versus just about all the currency in the world, that means our goods in the US are that much more expensive than they were. So that's a major part of our export economics is where's the US dollar? How are we selling our goods? So as the dollar continues to rally and make new highs due to the fact that we see economic issues around the world, that's not going to bode well for our exports. So again, supply tightening, but we're also going to start rationing our demand off, and we probably already have to a certain extent. So this is the kind of the fine balance that we have to watch going forward is the supply may want to make us very bullish, but at the same time, there is a level, there is a price where demand says, I can't afford that anymore, I'm out, and we start cutting our demand off. So this is the the fine-tuned balance that we're going to have to watch as we move forward here. Quick look at the energy markets, things I've already talked about. Natural gas has really made a serious screaming move higher here last week, mainly. A lot of that due to the pipeline being closed in Europe. This would transfer, and already has, really, the war has in general, a lot of Europe's needs to other places in the world. So we will see, LNG and propane try to be exported more so to Europe. However, due to their infrastructure, they can only import and physically offload so much at a time. So they are not able to just turn off the switch with Russia and simply move to the U.S. or other sources. It's not that simple. They'll try to get there and do as much as they can, but that's really caused that natural gas market to rally, and I'm sure we're seeing that in our bills here in the U.S. And again, crude oil, we've come down off of our summertime highs. This is, I believe, the November futures. So somewhere around $93 a barrel, but certainly off from the highs of 130 to 120. So that's one thing that, again, usually the corn market kind of coincides with that due to our ethanol market here in the U.S. I'm switching a little bit instead of the good to excellent numbers on Tuesday the USDA put out. I'm looking a little bit more at progress here just to kind of see the timing of our crop. Excuse me, you can see down here on the average, we're usually about 18% in maturity here at this stage of the game. Right now, they've got us pegged at 15, which, so again, not far off of where we should be. It felt like this spring that things would be really late, but I think it's going to be more of an average spring. Last year, really the last 2 years had been dry and early. This kind of appears to be more of a normal harvest. There's probably going to be a lot of corn picked from 25 to 20% down to 18%, but we're not going to see it come over the scales at 14 like we did last year. So again, Illinois, a little bit behind the average here. Normally, we're about 21% maturity. We're about 11% this year. Iowa's kind of right on where they should be. You go out here to Indiana, they're a little bit behind 9 versus the 15% average, and Ohio is just slightly behind the 8% average at 5. So kind of moving forward here. So it feels like the gut slot in Northern Illinois probably won't start till that end of that first week of October this year. And same thing with soybeans. So dropping leaves here, we're 10% as a whole versus 14% average. Same thing there. Now, the one thing that I find interesting here and is going to be very interesting as we move through harvest is it felt like over the last 5 years, the trend has migrated toward planting beans earlier and earlier. All the agronomists tell us this is what dictates high yields. Now, this spring, due to the cool and slightly wetter conditions, it felt like the soybeans didn't get put in as early as we would have liked or as we have the last 5 years. So my question is this going to dictate yield? Last year in Northern Illinois, it seemed like we had record yields. I was hard pressed to believe we would even come close to those. However, this August has been, fantastic for bean growth, filling the pods. We've had good rains. We've still had some heat. So really, it's going to be interesting to see if we can reach and get close to those records we had last year. Let's take a quick look at corn futures. Now, I'm going to bump a crop year here. I felt like we've talked a lot about the nearby corn marketing, which I wouldn't be scared to be somewhere around 50% plus sold on our nearby crop here as we move into the fall, just with the fact that we're at $6 prices plus, up to $6.50 at times. So instead, I'm going to shift gears, jump to December 23. I've got a couple marks here. If you go back to the peak when things were screaming higher there this spring in May, we got up to 680. Kind of waffled around a little bit in somewhat of a range from 625 to 680. You can see I've got the 640 high marked there. And then we kind of fell off here as we had good growing conditions here into June and July. Hit our low somewhere around 550. But really, since that point at the end of July, December 23 corn futures has had a great march higher, all the way up to where we're currently at of about 620. This to me looks like an opportunity. I'm sure a lot of guys are starting to have conversations with their providers on inputs. No question, fertilizer prices are going to be higher. No doubt in my mind that your potash and your DAP and things like that are going to be higher, mainly, again, because of the fact that so much of that is produced in Ukraine and Belarus. So that supply is hard to get to, is not moving, so I'm not going to be surprised to see higher dry fertilizer prices. However, we have to recognize the fact that at the same time, the corn market is higher. If you see good margins that you can lock in your fertilizer, then you probably should turn around and sell corn at the same time. So that's kind of my point is I want everyone, as they're having conversations on their input sides for next year's crop, to really make that decision or gather that information, and then at the same time turn around and check and see where your corn prices are. If you can get close to $6 cash or market some sort of futures floor above $6, we're locking in margins at that point. So something that really needs to be looked at. And then we'll go back to nearby beans here. This has been a little bit of a tougher market here recently. We've kind of had a somewhat tightening trend that we've been trading in here. The highs were up there around 1580. We've not breached those. We got up to a 1480 price here a couple weeks ago, and now we're sitting down sub $14 around 1388. There is going to be some resistance here at 1385. We probably need to stay above that and close above that today to not, I guess, open up the opportunity for more downside. Again, next week, we're going to have field data driven yield estimates from the USDA. We're going to have to watch that closely. A lot of people are not moving off of this 51 national average, so we'll have to see where that comes in. But I guess, if you don't feel you have enough soybeans sold, but we feel like the bean crop looks awful good and is getting bigger out there, 1350 beans times 70 bushel an acre is still a heck of a good crop, heck of a good profit margin there. So I guess I would encourage you to advance your soybean sales if you feel that you're not far enough sold on what looks like a really good crop in your backyard. And then I guess what I'm going to end this on is what I usually start on. The Ukraine-Russia issue continues. You know, Russia the last couple of days has threatened the idea of closing off the grain export corridor. I read this morning that Russia controls roughly 30% of the exportable grain right now. So if they decide to, you know, throw ships back into blocking the export corridor or just shut off the ports, this again throws that supply, which has been moving over the last month or so. It really shuts it off again. So a lot of volatility due to that. A lot of issues around the Zaporizhzhia nuclear power plant. This is the largest nuclear power plant in Europe. You know, it's really on the south edge of the corn growing area in Ukraine. You know, I don't even want to think about the possibility of a serious disaster there, but with the war and the conflict continuing, this is again one more issue in a part of the world that is important to the world food supply. You've got China and Russia, I think, are meeting actually here this week. At the end of the week, you'll see Xi Jinping and Putin are supposed to get together to talk about, you know, in general, their partnership or their views on the world. You know, China's the largest mouth to feed, and Russia right now has no friends. And can they strike up some sort of agreement? How would that change grain flows in the world? We don't know. As I've got written here at the bottom, high volatility will continue. As we see these days where there's a 20-cent move higher, or we see the markets waffling around the recent highs. You may be bullish, but at the same time, what's the downside? That I guess is the question: is what's your upside potential, and at the same time, what's your downside? And decide if it's profitable and how much risk that you're willing to stomach at that point. The good news is our crop here in Northern Illinois looks to be really good. The corn's standing certainly better than last year, so I think there's a lot of good profit potential here this year, and really there is next year as well if we're paying attention to it. So that's kind of how I want to leave you guys with here is get a good handle on what you think your crop is this year, and when you're done with that, get an idea on where your inputs are for next year and start making those sales and locking in profit if it's possible. So again, thanks for your time. This has been Brian with another market update for FS Grain.